Hi everybody, this is Thomas Wynn from Wynn Capital with the 2025 third quarter market summary. On the screen is my contact info, so reach out anytime if you have questions or comments. Before we get into the summary, let's look at a graph of the S&P 500 for the last 12 months. In brief, after the recovery from the tariff decline, we've been in a slow, very steady, and very low volatility rally ending the third quarter at all-time market highs. I've highlighted a few of the notable issues on the graph. All the way back in November of last year, we had the election. We went sideways for quite a while until the president was inaugurated and we started having some of the volatility that we all expected from the various policy changes. So the big decline for the tariff announcements, then the recovery from the tariff announcements. The budget bill passed as we started this this is a very low amount of volatility, so the declines have been very, very shallow and always been recovering so far. We had the end of the quarter right here, so we were at all-time market highs, and you can see from the little bit of the fourth quarter that we had another tariff was announced on China and a very quick recovery. Last Friday we had a gap up to a new all-time market high, and today the market's very strong, over about 1%, up about 1%. So I'm going to address this in a second. PE ratios are very, very high. The all-time high was 44 back in 1999. Now, a quick word about PE ratios and the questions of whether we're in a bubble or not. The idea that we're in a bubble is very subjective, but in general it means when investors and analysis think that that the stock market's overvalued. The main way we talk about the valuation of the market is PE ratios. Down here you can see that the median or average PE ratio over the last 50 years has been about 16. So people thought that the correct average price of a stock was 16 times earnings. So if it had earnings of $1, the stock could be 16. 16 times 1 is a PE ratio of 16. PE ratios are a reflection of investors' expectations of future earnings. We know what the last quarter and the last year's earnings are, but investors guess as best they can about the direction of the market and whether earnings are going to increase or not. When they have very high expectations, they give a very high PE to their stocks. Back in the tech bubble, all through from 95, there was a tremendous rally all the way up until 2000, and PE ratios got to 44, the highest in history. It turned out that the earnings did not materialize, that it was a bubble, that many of those companies that didn't have earnings or didn't have very good earnings went out of business one way or another. And so we had a pretty long period from about 2000 till 2009 of negative returns. After that, we've started the rally that we're in right now, and that's reflected in rising and rising and rising PE ratios. I can't emphasize this enough, that overvalued markets and very high PEs are not predictive. You can have high PEs for 10 years, and they finally will burst at one point. We'll obviously have a correction somewhere down the line. We just don't know. Getting out is a poor way to deal with overpriced markets. A better way is to reduce, take some profits, get to the low end of your stock allocation, and like us, we're able to hedge so we have some protection in case there is a market crash. So basically that's all reflected here. There's no idea when that's going to happen. You have to just stay in the market while it's overvalued, and then be very good about getting fully invested when prices are low. Okay, I'm going to leave it at that. I could go on longer, and I might try to do something about overvaluation in a future video. But what we have now is the normal first slide that we always look at. You could tell from the arrows all up very, very strongly for the third quarter. I've highlighted this average, and we're going up much faster and much stronger than we do normally. It's probably not sustainable, but it's great while it lasts. This next slide has returns for much longer periods, starting at 1 year, going all the way out to 20 years. We've had basically a very, very strong stock market from the bottom at 2009, so about 16 years of very strong returns. So this 20-year period and all the periods shorter than that are reflecting this 16-year very, very much more bullish than usual period. Great for time for investors, and we just have to stay very vigilant to make sure that we don't give it all away in the next decline or recession. Next, we have the third quarter price chart on top, and then the news that came out during the quarter down below. I've highlighted a couple things. The budget bill passed. Lower taxes is bullish for the market. The Fed cuts rates, that's bullish for the market. And then AI is underlying and is considered, the premise for we're going to have future efficiencies and benefits from AI. So all that's leading to a very, very bullish quarter. Basically the same type of graph with a price chart up above and then the news down below, but it's for 12 months, so going all the way back to last year. And one thing that is not considered too much, or the market basically ignored, was that the U.S. lost its last AAA rating. Our bonds were downgraded. We now will have to ask for higher interest rates, and we'll have to pay higher interest rates on our debt. So that could be negative, but it could be years and years before the $4 trillion of deficit spending that we just passed through the job for the budget bill will come to haunt one administration or the other. In my opinion, as you see the chart going up in an orderly fashion, that the market has started to ignore the daily strange news and economic policy and social policy that's coming out of the administration. I think what's taken over is that investors believe that policy is going to be favorable for the stock market for the foreseeable future. Nothing seems to be shaking the market out of that conviction at the moment. Now we're going to look at stock returns for the US, developed countries like Europe, and then emerging markets like China. And here we have the US stocks. The summary is right there in front of you. The US market makes up 63% of global wealth, global equities. Small value led the way, which is not been normal lately. Growth has been leading the way, but everything was up pretty significantly, but small value has finally had its day in the sun. Strong returns across the whole complex of US stocks. International, very, very similar story. Very strong performance. The developed countries of the world all together, that's all of Europe, Japan, other developed countries. Only 26% of global value is in outside the United States in developed countries. Value again was the leader of the categories and very strong, even stronger than US returns for the year to date. Now, international stocks, which includes China. So China's a huge economy, but as part of all those undeveloped parts of South America, Africa, and some parts of Asia are undeveloped economies. They only account for 11% of the value of all equities globally. Again, super strong in this case, strong across the board, but growth led compared to value leading in Europe and in the US. Super strong returns for the year to date. This chart shows us returns by country. A few countries on the bottom with pretty big losses, some huge gains, including China, up 20% in equities for the third quarter. The average global country was right here in the middle, just short of 10%, and the US was really close to the average. Commodities, even more volatile than usual. The policies coming out of the administration are shaking up markets in general and commodities, especially with changes to tariffs happening almost every day. On the top, we've got enormous gains in coffee and then precious metals. And on the lower end, we've got some natural gas and other commodities with pretty big losses. I always point out that it's very counterintuitive that commodity prices would actually be negative over the 15 and 20 year period. We're having some inflation right now, But over the long period, people that concentrate their investments in commodities, betting on higher prices down the line, have done very poorly for a long period of time. This last slide is a research paper from Dimensional Fund Advisors, as usual, and the slide addresses the question of how to benefit from the expected profits of AI. In general, DFA, like Wynn Capital, believes that owning a diversified portfolio gives us a higher probability of owning the winners. There's a vast body of research that shows that over time, diversified funds perform much better than funds that stock pick and market time and are not diversified. It's an interesting read. I hope you take a look at it. And that is it for now. I hope you find this all helpful. And if you want to give me a call anytime, go right ahead. Thanks a lot. Bye-bye.